Hi everyone, welcome to our latest edition of Summer School. I'm Ashley Rosser with Victory Fiduciary, and today we're so excited to be meeting here with Andy Craig. So Andy Craig is one of our local mortgage experts. He's been in the business over 18 years, currently the branch manager with his mortgage firm, and so we are really excited to be able to hear from Andy, hear about just kind of what you've seen over the past 18 months in the mortgage industry, and more importantly, what everybody wants to know is what our crystal ball says regarding what's going to happen in the future.
Yeah.
You know, when we meet with clients, obviously real estate, their portfolios, that's a huge part of their net worth, and so, you know, we've seen some crazy moves in the mortgage industry even just month over month, over the last 6 months. So I thought it would be beneficial to be able to kind of just sit down and kind of get your thoughts on what we're seeing and kind of where we're going.
Thank you very much. I appreciate that very much, and be able to talk with you and your client base and anybody else out there that's viewing this. We appreciate the opportunity. We love to educate. We love to share as much knowledge as we can so that you can plan correctly.
Sure.
As Ashley said, I've been in the mortgage business a little over 18 years. I can't believe it. Love what we do. We have a great team behind myself that within the branch that helps facilitate everything that we do. And our team, just in July, we crossed a milestone for us. We've helped 5,000 families over the last 10 years either purchase or refinance real estate, right? Residential, primary, or residential, primary, second homes, or investment properties. So we're excited about that. We love what we do, and I love to be here to be able to share some of those things.
Great. Thank you. We appreciate you having me here.
Sure. So the market, what's going on, right? So COVID hit, right, back in 2020, and it threw us upside down, right, from a real estate perspective, from a mortgage perspective, and folks were having a tough time understanding what was happening. So I'll tell you one of the reasons why you've seen such a rapid rise so quickly in interest rates. I'll give you a Cliff Notes version of that. Is that the Federal Reserve had to step in during COVID, and they had to level the playing field and bring some clarity back to the mortgage market. And what they did was they were buying mortgage-backed securities, which is, what does that mean? That means they purchased things in the secondary market for you and I on the retail market side, right? What they were doing was hopefully keeping the retail interest rate low so that they could spur growth during an economic downturn, right? With what was happening with
kind of
COVID.
like holding the hand kind of
Sure.
the market to keep things afloat.
It's a great analogy, absolutely. So the Federal Reserve did that. They did that strong for about 2 years. They were buying mortgage-backed securities in the billions of dollars on a monthly basis, and they've started to unwind that bond buying process. And what's happening is you're seeing mortgage interest rates come back up to where a normal market should be, okay? So historically, though, if you look back, and we have a chart here that I'm not a big fan of charts, but we're going to go over a chart that's going to review some of those historical numbers. And all in all, though, we're actually not too far off what the average rate has been for almost 40 years. Right. So I want to share that with you if I can. So
Absolutely.
First chart we're going to look at here is what's happened just since October. And the reason why I picked October for you is because that's when the Federal Reserve came out in October of 2021 and said, hey, we're going to reduce our bond buying campaign. And as soon as they did that, we could see a change in the interest rate pattern. So the top line you see here is actual mortgage interest rates, the mortgage-backed security market, which again creates retail interest rates for you and I, for my mortgage, for your mortgage, for yours. The other line here is the 10-year Treasury. Why do we point to the 10-year Treasury? Because most people either sell or refinance their home within the first 7 years of ownership.
Interesting.
So it's a good gauge on what's happening with the 10-year Treasury. You can see what happens in the mortgage-backed security market and the retail interest rate. So as that 10-year Treasury climbs, you can see on the right-hand side there, the mortgage interest rate security goes the other way, which creates a higher mortgage interest rate.
I just want to make sure that
Yeah.
everybody can kind of see over here, just kind of, and then again, as we began to see that spike, you can see it's starting to change there a little bit.
Absolutely. So, and we just talked about, well, historically what has happened. So if we rewind the clock, let's go back to 2010. 2010 is just after the financial crisis that we had related to housing. This market, nothing like that market whatsoever, right? That market was way too much supply, not enough demand, maybe some scrupulous lending practices.
Yeah.
None of that's present any longer. And you can see now what has happened. If you go back to 2010, we were kind of in the same position, right? And over years, markets have cycles, right?
Yep.
So we're in that cycle now where we're back to a little bit more of a normal market when it comes to interest rates. Still not an interest rate that is not tolerable for the market, right?
Sure.
Jobs, the economy, things like that are most important thing to housing, but interest rates do play a part in that, but affordability is still strong.
And I think it's important to kind of note too that, we did kind of get used to these artificially deflationary
Sure.
interest rates. And so that kind of became the normal in people's minds, but that was not normal. That was never meant to be. We were never meant to have suppressed interest rates, at 3.5% forever. It was really kind of like an emergency,
Sure.
stop. And so I think it's important, when we saw that chart, just as a reminder about where we actually are.
Sure.
We're really kind of back to where we should have been kind of all along, and had the pandemic crisis not happened, it's likely that we would have never seen rates as low as we saw.
Interest rates that I'm quoting today, actually for borrowers, are lower than they were in January of 2020.
Wow.
So January 2020, just before COVID, hit, and that time frame, I'm actually at a lower interest rate now than I was in January
Wow, that's
2020.
fascinating.
Yeah.
And I think that as borrowers, we kind of get caught up on these numbers, oh my
Sure.
gosh, it's so expensive to borrow. Well, no, it's just now this is the normal.
Sure.
We're kind of back to some normality there. So I think that's important for
Sure.
for us to be able, and just as reminders, we've on our video series we've talked a lot about just market cycles, just the stock market goes through cycles as well. Things
Yes.
cannot stay on the same trajectory forever. We have to, in order for things to stay healthy, we have to kind of go through these cycles. And so
Absolutely.
the mortgage rate environment is the same, just in general interest rates.
Yeah,
So
it's not insulated from that, right? It's all these different economies are going to go through those changes, right? Depending on what it is. So one of the things we wanted to share with your friends here is some of the things that we've been doing for folks to create cash flow for themselves, maybe in a higher inflationary time that we're in, or maybe you accrued some debt during the COVID time frame that you want to consolidate. Because one of the things that is, I guess, a benefit to some of the inflation that we're experiencing is high market value for your property. Real estate increases in value. And we've helped some folks be able to create great cash flow for themselves, leveraging that value and that equity that they've created because of this market. So I want to share with you just one quick example of someone that we just recently helped. And this happened, we just helped this client in July of this past year.
Okay.
And I helped them actually purchase this loan. Or we did a purchase for them back in 2019. But in 2020, in July, when rates plunged, we refinanced them to 3.25% on their interest rate, okay? But since then, and I'll step out of the way here, these are some of the debts that they've accrued since I helped them in 2019 purchase their property. So some personal loans, credit card, car loans, when you add everything up that they were paying, so their mortgage at 3.25 plus all their other debt combined in those 6 accounts, they were pushing out $5,000 a month, almost $5,100 a month of post-tax income, right, to their liabilities.
Revolving debt, okay.
In revolving debt. So we analyzed their equity that they had in their home. We went through a couple different scenarios to see what was going to be the best way to leverage that equity, and this is what we ended up doing for those folks. So we created what I call cash flow via the cash out refi, and we took their mortgage payment up actually. So remember, you could see here we were at 3.25 at $2,900. So we took the mortgage rate up to 5.75. Why would you take your mortgage rate up over 2%? Well, because leveraging the equity that they've accrued in their home since 2019, we eliminated $65,000 in debt.
Wow.
575 was the house value in 2022 versus the purchase price of 375 in 2019. So lots of equity. And when we combined all those things and paid that off, $1,300 a month in cash flow now back into their personal household economy.
Positive after. So now that's just taking care of those other liabilities.
Absolutely. During that time frame, same client, my last point here, same client ended up spending money and getting a pool. A lot of people got pools during COVID because they were at their house, right? So that liability we left out there at $688 a month with a $60,000 balance, but they're saving $1,300.
Wow.
If they just apply half of that $1,300, they're going to pay this pool off in about half of the time.
Wow.
Be debt free and then they want to be on the path to buy that retirement home down the shore because they're about 12 years away from that, to be able to purchase that home down the shore, accrue some savings because we were able to do that. And oh, by the way, guys, if history is any indicator and you look at those charts, rates are going to come back down. We'll probably end up refinancing them again to bring this payment back down.
Wow. And so, because just, the advisor in me, as I'm seeing this, I'm thinking about, just in general, how many people living paycheck to paycheck don't have a whole lot of positive, income at the end. Like having $1,300 that maybe you can begin to contribute to your 401k if you're not already doing that, contribute to a brokerage account or to an IRA, or be able to, use that to continue to accumulate wealth for yourself. I think could be a really powerful tool. So it's an interesting kind of look at being able to kind of leverage these appreciation and home values that we've seen for people though who don't want to leave their home.
And not using cash that you have accumulated over time to pay down those debts. Use that cash, like you said, to continue to invest and let that money grow for you, and use the equity in your home at a really decent interest rate. It's not that bad, right? At 5 3/4. And if I was to originate this loan today, 35, 45 days later, it's probably 1/4 to 3/8 better in an interest rate because the rate market is improving slightly.
Wow.
Yeah.
Well, that's, I like I said, when we talk about this off camera, it's fascinating to me just having this strategy where homeowners could potentially take advantage of this appreciation, because I think most people, when we talk about home values increasing, we say, well, that's great for 15 years down the road if I'm going to sell, or 20, especially for people who either just refinanced or just purchased a couple years ago.
And I will tell you, a lot of the questions that I do get in closing here for me is that, well, how much equity am I using? What's my loan to value? How much am I borrowing against my house's value? And normally I advise clients, don't go more than 70% of the value of the property. Okay. Just in case there is some sort of small market change, downturn, you know that if you do have to sell, you're not going to be in a position where you're upside down. You would still have equity in your home to push that towards another potential purchase or whatever you need to do with those funds. So we like to be conservative too in our approach as well.
That sounds like a prudent approach, certainly, for doing that. I think that, again, it's just an interesting kind of take in terms of, because we're always kind of looking for how can we help our clients, help their money work for them, right? How can you make your dollar work a little harder? And so this, for some people, may be a strategy that can help them.
Well, I appreciate the time and the opportunity. We look forward to helping anybody that has questions, even if it's just a scenario. We love to do that. Again, education is key, and we love to educate.
That's excellent. So, again, I'm Ashley Ross with Victory Fiduciary, and this is Andy Craig. And so we thank you for joining us. And I know that during these times, particularly in these past 12, 15 months, we've had just, again, a lot of questions. We've seen some really just kind of unprecedented moves in not just the stock market, but the real estate market, the mortgage market. And so, our hope with kind of bringing these talks to our viewers and our clients was to just kind of hopefully shed a little light, bring some education, and help give proper kind of just perspective so that people can continue to make educated decisions. That's really what we always take our role on with our clients. I know you do the same, and so we really appreciate you taking the time to tune in with us. And again, if you have questions, you can reach out to Andy Craig directly. His contact information was at the beginning of the video there. I know he'd be happy to answer any questions. You can always reach out to me, certainly, if you have questions as well. Thank you so much. We look forward to you joining in our next edition of Summer School coming up soon. Thank you.